Coming up on Business Incorporated. Controversial $5 billion Grand Ethiopian Renaissance Dam begins producing power. And all eyes on South African Finance Minister for presentation of government spending framework for the next 3 years. Plus, money sent home by Kenyans abroad drops 3.4% in January. Great to have you join us on Business Incorporated. I'm Ladi Williams. We kick off this week's edition with market numbers from major equities on the African continent. We see trading was mostly in the green at intraday as Nigeria's main index rose 0.14%, while South Africa's performance index fell by 0.34%. On the flip side, Egypt's EGX30 edged up by 0.71% at intraday. Meanwhile, the Nairobi Stock Exchange closed Friday's trading session in positive territory, up 0.21%. And over to the Middle East, trading activities were mixed. The Abu Dhabi index plunged 1.18%, while Dubai's main index fell by about 0.39%. Still within the region, Saudi Arabia and the Qatari exchanges recovered gains at intraday. Both indexes rose 1.07 and 0.02% each. All right, moving on to Europe. Now, trending right now is the massive leak of data from Credit Suisse bank accounts. The so-called Suisse secrets appear to show the Swiss bank allowed people convicted of a range of criminal activities open and maintain accounts. Let's get more now from Rob Watts right there in Berlin. Great to have you, Rob. Well, tell us more about this massive leak of data from Credit Suisse.
Yes, we had the Panama Papers, the Paradise Papers, or this leak they're calling the Swiss Secrets, a huge haul of documents relating to 30,000 clients of the bank with accounts holding a total of $100 billion. Were involved. It was initially leaked to the German newspaper, the Süddeutsche Zeitung. This was by an anonymous whistleblower. We don't know if it was an individual or a group, but they said that their motivation was to show the immorality of Switzerland's banking secrecy laws, which they say are a fig leaf covering the shameful role of Swiss banks as collaborators of tax evasion. More than 40 media organizations have been poring over this information for months now, and they say that the documents show Credit Suisse provided bank accounts to people and organizations involved in a multitude of crimes, including human trafficking, money laundering, political corruption, and even torture. Now, all of these people were able to shield their money in Credit Suisse accounts, protected by those Swiss secrecy laws.
Well, quite interesting. I guess the whistleblowers are out again. But what does Credit Suisse have to say in its defense?
Well, the bank says this is the attempted discrediting of Credit Suisse. Credit Suisse says that Switzerland's strict banking secrecy laws prevent it, actually, from commenting on claims about specific clients. However, it says it strongly rejects allegations and inferences about its business practices from these documents. It claims that the reports are based on selective information taken out of context. It also says that the documents are largely historical, dating from a time when laws, practices, and expectations of financial institutions were very different from what they are now. Now, it is true to say that some of the data does date back as far as the 1940s, but 2/3 of these accounts detailed in the leaks were opened since the year 2000, so not so historical. However, Credit Suisse says it's reviewed a lot of the accounts included in the leak, and 90% of the reviewed accounts are now closed.
All right, so trading is returning to Europe's stock markets. What can we expect for this week?
Well, last week, the markets were dominated by the tensions between Russia and Ukraine. We saw them rise and fall as hopes of a Russian withdrawal of troops from its borders were raised, then faded away. Well, we can expect more of that this week, really. We've already seen Asian shares fall on Monday, following on from losses on Wall Street on Friday. However, developments over the weekend may help to calm the markets today. US President Joe Biden and Russia's President Putin have agreed in principle to a summit over Ukraine, suggesting that a diplomatic end to this crisis is still possible. That hope helped rescue the ruble after it clipped a one-week low earlier on Monday. We've also seen the euro rallying as well, having lost ground earlier on in trading. However, the fact that US officials do seem to think that a Russian invasion of Ukraine still appears increasingly likely, that could overshadow any optimism we're seeing.
All right, I guess investors will be watching out for that. That was Rob Watts right there in Berlin. Thank you so much, Rob. All right, moving on to the UK now. We see UK business activity for February. It's already looking good. Let's hear more now from Juliana. Great to have you, Juliana. So I see the PMI index, which includes manufacturing, services activity, jumped by about 60.2. From 54.2 in January, making an 8-month high. That's some good news.
Yeah, it is great news. Good afternoon, Laddie. I think this data from the PMI, which has a forensic look at Britain's private sector, does show that the Omicron-induced slump that we witnessed in December is well and truly over. As you said, this data for the month of February is an 8-point high. This is the biggest surge that we've seen month on month since the spring. And I think it's really tailed to the fact that all Plan B restrictions were lifted. It shows that there was a surge in travel, leisure and entertainment spend. I think the most important part of this data is really the services sector. This is contributing to about 80% of Britain's total GDP. The service sector employs about 82% of individuals, and that has really, really surged. So it does show that we are on track to maintain this biggest economic revival out of the COVID-induced slump as we go on into the year. There are some concerns. I think economists have really highlighted that inflation is still a huge issue, higher wages. Lots of employers are demanding that at the moment. We know that supply chain restraints are causing higher inflation, which is the reason why there is now more pressure on the Bank of England for a third consecutive time to rise interest rates. They're currently at 0.5%. Are they going to go to about 0.75%? That's what's expecting when the MPC meet at Threadneedle Street later next month to try and curb back inflation, which is expected to rise to about 7.5% in this country.
Yeah, everyone trying to fight inflation at this point. But let's look at some M&A now. I see the UK takeover spree continues with a move for Clipper Logistics, a Leeds-based warehousing company. And we also have the Menzies. I guess the fight for UK assets by foreign companies continues here.
Absolutely, it does, particularly in the kind of logistics sector, which has really grown, last mile logistics, particularly during the pandemic, where lots of people were at home relying on online services. The John Menzies story, big story, because we know that earlier this month they rejected two bids by the Kuwait-based National Aviation Services, but they've now upped their bid to £595 million. And we're hearing from the John Menzies board that they're willing to accept the offer if the Kuwait-based firm are able to stick to some regulatory issues. This is a really good story for the firm. It's over 100 years old. I believe it's been listed on the London Stock Exchange since 1962. They handle lots of ground services across 200 airports in the world. This includes de-icing, cargo, bag handling. They had a pretty rough COVID-19 pandemic, of course, because passengers weren't flying, but their cargo services remain very sought after, which is why I believe last year they made just shy of £1 billion. One of the reasons why NASA really interested to get their hands on them. So we're still waiting for final board approval. And because this is their third bid, I believe they have until the 9th of March to make sure they check all the options with the Competition and Markets Authority to actually put in a firm bid or remove the offer. But it does appear as if John Menzies are pretty happy with this.
All right, we'll keep tracking that. But it seems investors were excited about this Clippers move. I see the Clippers share jumped about 14% in the morning. How are the markets looking now?
Yeah, the markets had some strong gains earlier today. They appear to have dissolved in intraday. The FTSE All-Share is actually down at the moment by 0.08%. The FTSE 100 is up by 0.03%. And the FTSE 250, the domestic market, that's also down by 0.83%. In the currencies market, the British pound is currently up on the euro by 0.31%, up on the dollar by 0.31%, though down on the euro by 0.04%, and up on the Japanese yen by 0.17% at intraday.
I'm sure investors need a relief rally right about now. All right, Juliana, thank you so much. Enjoy the rest of your day.
Thank you.
All right, moving on to Asia now. Shares in Asia Pacific were mixed as investors continue to watch the situation surrounding Ukraine. Meanwhile, China left the benchmark lending rate unchanged. Nikkei 225 in Japan fell 2% momentarily in the morning before retracing some of those losses, eventually ending the trading day 0.78% lower at 26,910 points, while the Topix index shed 0.71% to 1,910. South Korea's Kospi closed mildly lower, 2,743 points. Mainland Chinese stocks closed little change. The Shanghai Composite largely flat at 3,490 points, while the Shenzhen Component climbed fractionally to 13.471 points. Hong Kong's Hang Seng Index declined about 0.8% out of its final hour of trading. Elsewhere, Australia's S&P ASX 200 closed 0.16% higher at 7,233 points, while the Straits Times Index in Singapore also advanced 0.17%. All right, moving on to East Africa. Now we see Kenyans living abroad sent home 3.4% less in diaspora remittances at $338.7 million in January, compared to a monthly record high of $350.6 million. For analysis now, we have Messi Milanoy, business journalist in Kenya, joining us. Great to have you.
It's to be here,
Yeah, so what do you think? Yeah, what do you think contributed to this downturn in diaspora remittances?
Well, the remittances January, actually the highest compared to the period that we've been through during COVID-19, of course, with the rest of the world, between 2019, 2020, and 2021. But also there has been a 3.4% reduction in terms of the money that was sent home from abroad by Kenyans. And of course, from the Central Bank of Kenya, they've termed this to be on a seasonal change. And mostly what we are seeing is that a lot of money was sent through in December, in January. There has been a dip towards February. And also, if you look at, there's been a bit of competition in terms of the funds, considering that mostly Kenyans send money back home for different reasons, investments, taking care of family. So the central bank is quite at least confident that, of course, we'll be able to increase this. But as of now, they are simply terming this as a seasonal change, most probably from the festivities of December and, of course, settling into the year in January. But, of course, they expect the remittances to increase towards the rest of the year.
Because I was wondering, maybe they weren't making that money abroad, but do you see this trend continuing?
Of course, not likely, but also one of the other biggest concerns that came about from the report from the Central Bank of Kenya is also the competition, and of course that's within the Kenyan shillings. If you look at now, imports are increasing, we are importing a lot, and of course we're not exporting as much, but at the same time also remittances have always pushed onto the Kenyan shillings, but not as much, because as of last week, the week before, the Kenyan shillings was at 113 shillings and 64 cents against the USD, compared to 113 shillings and 63 cents compared to the other week. So the remittances have always enabled us to push on the Kenyan shillings, but as of now, not very much, especially from the last 2 weeks. But from the regulator, they're hoping that, of course, we'll be able to have more money coming back at home. And of course, I'll be able now to balance out the Kenyan shillings. Though right now, the tourism sector is also picking up. So we are seeing a lot of foreign tourists coming into the country to visit the country. And also, we are now exporting a lot of tea. Exports have resumed fully. So we're expecting that, of course, apart from the remittances, we've also the tea and also the tourism will help us to balance and maintain the Kenyan shillings against the USD. But definitely, of course, towards the rest of the year, of course, April is coming, and there are a lot of activities that will be taking place in Kenya. And of course, Kenyans who are away will be able to be sending back home. And of course, most of our remittances comes from the US majorly, and the UK, Canada, and also Germany, and also here in Africa, most of our remittances comes from Tanzania, Uganda, and South Africa. So we are hoping, at least as the year picks up and the economy picks up generally across the world, more Kenyans will be sending money back home.
All right, well, I guess we're expecting more money back home in Kenya. Thank you so much, Mercy Milanoy, business journalist right there in Nairobi. Thank you. All right, so after the break, I will look at more stories on the African continent. That's in a moment. Do stay with us. Welcome back. You're still watching Business Incorporated live on Channels Television. Now to our next conversation. South African Finance Minister Enoch Godongwana will present the government's spending framework for the next 3 years on Wednesday as the economy struggles to recover from the damage wrought by the coronavirus pandemic. For expectations now on the spending framework and economic outlook, we have Matt Kindiger, practice lead, Sub-Saharan Africa Front of View, join us. Great to have you.
Hi, thanks for having me on the show today.
Yeah, so what are the main themes you're expecting to emerge from the budget speech on Wednesday?
Yeah, certainly. So I think everyone's going to be, or everyone that's interested in South Africa will be glued to the budget speech. I think there are three main themes that will emerge during the budget speech on Wednesday. The first is on taxes. So because the government's revenue generation over the last year or so has been slightly better than they were previously forecasting, we are expecting very few changes to taxes. And this crucially means tax increases are likely to be avoided, which is generally quite positive. But it does also mean that the government's aim to cut taxes to stimulate the economy is also unlikely, because it does still face a very significant deficit. Another theme is around civil service wages. So the government previously, during COVID, it was planning to use the cutting of civil service wages as its main tool of advancing fiscal consolidation. It's probably going to struggle to cut civil service wages because of political pressure to keep civil service wage growth high. But we are likely to see, probably at inflation or maybe slightly above inflation, civil service wage growth. And in terms of spending priorities, that's the other major theme. We're probably going to see very limited real terms increases to government departments and recurrent expenditure. But the one area that is likely to see above inflation increases is infrastructure investment, because the government sees this as a major driver of the economic recovery. So that's probably the one area that we're going to see a bit of a more optimistic spending outlook.
All right, Matt, but what would the budget mean for, growth outlook for South Africa's economy?
So because the budget speech will probably reveal moderate progress towards some fiscal consolidation, or you can put it another way, we are unlikely to see a significant deterioration in public finances. The prospects of a credit rating downgrade are unlikely, so they're quite small at the moment. And this is good in terms of sentiment and also the stability of the rand. So that's probably the first most immediate impact. In terms of the impact on GDP growth, it's probably going to be very muted. It's unlikely to affect growth significantly positively or negatively over the next year or so. And this is because the government has very little scope to cut taxes, as I mentioned earlier. But it also has continued pressure to consolidate public finances. It has during previous budget speeches, the government made it very clear that it wants to balance the budget by the middle of the decade. And so this also means that it can't really stimulate growth. What we could see, however, is a bit of an aggravation of inflationary trends that we've seen in South Africa recently. This is because the government will probably reveal an increase to fuel levies, which will raise fuel prices, which are already increasing. So that could have a short-term immediate impact as well.
Yeah, quite a lot to chew there. But how are businesses likely to be affected by, the budget over the coming year?
So there are two things to consider. One is around the operating environment, and the other is the demand environment. So in terms of the operating environment, the fact that tax increases are likely to be avoided over at least the next 6 months is broadly very positive from a planning perspective, but also a demand recovery perspective. Consumers, households in particular, and companies that sell to households will be breathing a sigh of relief, we expect, because income taxes are unlikely to be increased. VAT also unlikely to be increased. So that's probably going to be quite positive from a demand perspective, in the private sector at least. But from the public sector, we are expecting to see quite weak demand growth from the government over the next 6 months or so. So quite different from a private and public sector perspective. One thing we would caution, however, is that when we look at the midterm budget speech later on this year, we expect tax increases to become more likely. So that is probably something that businesses should consider when they look, towards October, November this year and into 2023.
All right, I guess all eyes on Finance Ministry come Wednesday. Thank you so much, Matt Kinniger, Practice Lead, Sub-Saharan Africa, Front of You. Always great having you on the show.
Well, thanks for having me today.
All right, moving on now to back to East Africa. We see Ethiopia began generating electricity from its giant hydropower dam on the Nile River tributary project, sees as key to its economic development, but has stirred tensions with downstream neighbors. Ethiopian authorities confirmed the Grand Ethiopian Renaissance Dam can now start the first phase of generation at a ceremony attended by Prime Minister Abiy Ahmed in Juba near the border with Sudan. The GERD will be able to generate a total of 5,150 megawatts when finished, and the project started a decade ago. It's cost $5 billion and is now scheduled for completion in 2024. Ethiopia last year completed the controversial second phase of filling the reservoir despite strong opposition from Sudan and Egypt. Horn of Africa country says the dam is key to its long-term development goals and has sought to downplay its neighbors' concerns. And Egypt is ready to export locally made COVID vaccines to African nations, looking to position itself as a hub for inoculations on the continent grappling with the virus. Egyptian authorities are expected to discuss potential export plans with a Chinese delegation at the end of February, and that's according to the president of the state-run holding company for biological products and vaccines. The move comes as a government official say the batch of locally made Sinovac vaccines had been sent to the Palestinian territories and the first overseas shipment. The Arab world's most populous nation is positioning itself as a hub for COVID-19 vaccine exports, with Vasera producing Sinovac using materials from China. The World Health Organization said February 18 that Egypt was one of 6 African countries that will be given technology to produce mRNA vaccines. And it appears Uganda and Tanzania are looking to improve trade relations, especially with milk and milk products, as both countries locked horns over alleged breach of common market protocol. According to Uganda, Tanzania was imposing unfair charges on its traders, and Uganda complained that Tanzania was charging its truck fees way higher than it was charging other trucks using the same border and road. The allegations hold that Tanzania was charging Ugandan truckers up to $500 toll fees for truck, yet it charged only $152 for Rwandan and other trucks. Uganda argues that its trade volumes are being affected by other non-tariff barriers, including but not limited to restriction on exports such as sugar and milk. Uganda exports to Tanzania was recorded at $122 million in 2021, according to United Nations Comtrade database on international trade. And Tanzania exports to Uganda and were clocked in at a whopping $1 billion last year, with a total annual trade worth of $171 million between the two neighbors. As of January 17th through the 19th this year, the two countries came to the table and ironed out their differences in the Ugandan capital of Kampala. When the meeting ended, the two sides had unconditionally signed for the removal of all non-tariff barriers between them. And Tunisia and the International Monetary Fund are in preliminary talks with an eye on a potential multi-billion-dollar rescue deal for an economy plagued by recession, public debt, inflation, and unemployment. North African nation started talks with the Washington-based crisis lender, which has called for deep reforms and public spending cuts. But many Tunisians, already struggling to make ends meet, fear a deal that involves painful reforms could leave them much worse off. Tunisians have endured a decade of economic stagnation since the revolt that overthrew dictator Zine Abidine Ben Ali in early 2011. Two previous IMF loan deals for $1.7 billion in 2013 and a further $2.8 billion in 2016 have done little to fix the country's public finances. And that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Bye-bye.